I'm the Chuck in the Markets Up Chuck, and today's log was titled United It Stands, kind of in recognition of United Healthcare reporting earnings today, the largest health insurer in the country. And, what I thought it would be important to do, there's an awful lot of talk about healthcare reform today. In fact, there's several articles you could check in today's Wall Street Journal even, for example, that talk about what's going on with healthcare, whether the current administration can get it done or not. But the bottom line is, the result is that it's created a lot of uncertainty, which has also created some extremely low valuations. So I'm going to look at three of the major players in healthcare. The first and the smallest will be Humana. And I want you to look at this from the standpoint of the fundamentals. This is a 20-year chart on Humana. As you can see, their earnings have been, somewhat inconsistent in the first years here, but I want you to notice how stock price followed those earnings. Then they had a pretty good run of earnings here in the middle, from the period 1999, up through 2007. And of course, stock price followed that. There's always going to be volatility in stock prices, but always note how the price follows earnings. And then we had, of course, the recession, and then we had the new administration coming in, a new government, and all the talk about healthcare reform. And all this added up to one of the, most significant drops in Humana's stock price in history, and I'm going to argue significantly more severe than, an actual earnings drop that they did experience, as all three, as you'll see here in a moment, did. But the point is, this stock is trading now at less than 6 times earnings. The market has historically, put it at a price-earnings ratio of around 18 or 16 to 20. And the reality of it is, these stocks are extremely cheap right now, pending the idea that there could be some real severe healthcare reform, coming up in the very near future. My second example is WellPoint Inc., and as you can see, they've been public since October of 2001, and they have strung together a very impressive string of earnings growth. Earnings went from $1.71 to $5.64. They had their first down year in earnings, in 2008, thanks to unemployment and the recession, et cetera. Once again, the stock price fell, but it held up certainly better than Humana did. It's currently trading, however, at around 10 times earnings, and has been in the single-digit price-earnings ratio, which again I want to point out is excessively low for companies of this quality. This company has generated a track record, if you look at it, that has been very favorable compared to the S&P in the 9 years or since October 31st, 2001. The S&P has actually lost money on a compounded annualized basis of minus 1.4%, and WellPoint has actually made money. But that's measuring it at these extremely low valuations right now, which again I believe is overreaction to a lot of what's going on in healthcare. So WellPoint is certainly on sale right now relative to what it would normally historically be trading at. And my third and final example is United Healthcare. I want you to notice how consistently this company grew earnings year after year after year, all the way through 2005 and all the way through 2007. But there's starting to be some weakness, a little slowing down in the growth rate, and the stock price did kind of fall just prior to the recession. But since the recession came and we had the first blip in earnings here, I want you to notice the stock price fell from, in December of 2007, it was around a $58 stock. It fell all the way down to $14.51 in 2008. It's since recovered to $24.84, but still trades at 18 times earnings. And this is a company, it's trading almost a third of its normal price-earnings ratio. And again, the reality is everyone's fearing healthcare, but there's, as I point out in the blog, there's a lot of reasons to believe that, the compromises are going to still make room for the private health insurers to prosper during the current reform. They may not make as much margin as they have in the past. It may be harder for them to make money, but the point I want to get at is I don't know that you're going to see this kind of growth again, probably not. However, I would argue at these extremely low valuations you find today, the downside is very, very well defined, and there is certainly a lot of upside just in normal price-earnings ratio expansion. If you look at the forecasting basis, according to Zacks, there were 11 analysts are expecting a 14% growth right now. As I pointed out in my blog, they had a 70% plus increase this last quarter coming off a very low base, but this company could conceivably grow it at 10 to 15% a year for the next 3 to 5 years. And if the price-earnings ratio just got back to its growth rate of 14 times earnings, it would be a $43 stock by the end of the year. And if it got back up to a more normal 20 times earnings, it could be as high as a $64 stock. So I think it's a tremendous company on sale. As you can see, their long-term record here, and this is the largest with the longest record as a public company. It's generated almost a 26% compounded rate of return for shareholders versus only 5.6 for the S&P 500. So here you have a look at a company who's normally would track according to their fundamentals. I believe this is a lot of fear and uncertainty have caused a tremendous opportunity for those willing to take a little bit of risk to look at a company or a group of companies, for that matter, that are very, very, very cheap today, and could be, excellent short and long-term investments. Hope you enjoyed today's blog. It's Chuck Carnevale saying thanks for listening, and talk to you again tomorrow.